Thank you. Good evening, everyone. I welcome all the participants to the fourth quarter 2017 earnings conference call of Rain Industries Limited. Speakers on today's call are Jagan Reddy Nellore, Managing Director of Rain Industries Limited, Gerard Sweeney, President of Rain Carbonate, and T. Srinivas Rao, Chief Financial Officer of Rain Industries Limited. During the call, management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. We recommend viewing this presentation while listening to management's discussion. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Jagan to provide an update on key developments within Rain Group during the past 2 years. Over to you, Jagan.
Thank you, Ryan. A very good evening to all the participants. At the outset, I would like to share some significant developments during the last 2 years in Rain that has allowed your company to deliver consecutively a better performance quarter on quarter. We continue to benefit from our strategic initiatives aimed to de-risk and decommoditize our businesses over the last few years. In addition, the functional integration of our global teams enabled us to optimize raw material management, drive cost reductions, and increase capacity utilization to capture value in the improved market conditions. The company successfully completed 6 key capital projects in the last 2 years. It's a great pleasure to inform you all that Rain has successfully completed its second phase of refinancing in euros, which has enabled your company to reduce its interest rate on the redeemed debt by about 500 basis points and also extend its major debt repayments until 2025. During the course of refinancing, we were able to achieve an ideal debt mix between euro and US dollar debt to match the underlying cash flows of the company, limiting any impact due to the exchange rate fluctuations. Further, the US dollar debt, being in bonds at a fixed interest rate, will not be impacted by rising interest rates in USA. In addition to this, an internal reorganization was implemented to roll up 9 redundant companies in Europe and to allocate debt to our European operations, allowing us to optimize the location of our debt. Turning to slide 4 on completed projects. As discussed before, the company completed 6 capital projects in the last 2 years, and these projects continue to operate as planned and are contributing to our improved performance. We continue to evaluate bottlenecks at our existing production facilities in order to expand capacity utilization. This allows the company to maximize our performance with minimal investment, as was done at our distillation plant in Hamilton, Canada. With just under $2 million of CapEx investment, we were able to push the production to its rated capacity. Each of these projects are contributing to the company's sustainable performance with year-over-year improvements. Turning to slide 5. Rain is pleased with the improved performance during the fourth quarter of 2017 compared to the fourth quarter of 2016 due to the continued benefit from favorable market dynamics together with the strategic initiatives implemented during the last 2 years. The performance of the chemical and cement businesses was weaker in this quarter, primarily related to the market conditions in which they were operating. In the fourth quarter of 2017, Rain achieved consolidated revenue of Rs 31.24 billion, consolidated adjusted EBITDA of Rs 6.87 billion, and consolidated adjusted net profit of Rs 2.98 billion. From the exchange rate fluctuation perspective, the impact from the appreciation of euro is substantially offset by depreciation of the USD against the rupee in the fourth quarter of 2017. Now, Jerry Sweeney will take you through the industry developments on the next slide. Jerry?
Thank you, Jagan. Good morning, everyone. It's a pleasure to speak with you all again. On slide 6, in the upper left bar chart, as discussed in prior quarters, aluminum demand continues to grow worldwide. As you can see, the bullish trend is projected to continue in the forward years as well, something we believe the uptick in the global economy over the last few quarters will continue to support, if not accelerate. On the upper right, we see the healthy performance in the LME aluminum price, trading between $2,100 and $2,200 per ton for some time now. Consistently most bullish on this graph is the continued decline in LME inventory levels, which is supporting the aluminum price above $2,000 for the last 6 months. The lower LME inventories and higher aluminum prices, coupled with moderating production levels in China, has led to the restarts mentioned on slide 7 coming up. The world is still wary, however, of the high inventories in China and where these volumes will ultimately wind up in the future. Dumping of aluminum has garnered a lot of attention over the last few years in many countries, especially India and the U.S. If this pattern continues, we expect governments will ultimately take action to block or heavily tax these Chinese imports. On the lower left, fuel oil prices in the fourth quarter 2017 improved slightly, maintaining their gains over the last few years. Fuel oil prices have increased almost 26% in the fourth quarter of 2017 compared to fourth quarter 2016. Commodities such as benzene and orthosilane have followed a similar price trend, which has a positive effect on our other carbon product revenues and earnings, specifically our naphthalene, phthalic anhydride, BTX, and carbon black products produced from our distillation plants. On slide 7, Asian primary aluminum demand is up 14.3% year-to-date December 2017 in the most recent industry updates. This is welcome demand growth helping to consume China's excess aluminum production. The increased production growth has also driven China's carbon markets into a heretofore unforeseen situation of being tight on availability. This has helped create the favorable market conditions we see on both our CPC and CTP, or coal tar pitch products. On the upper right, you can see this has resulted in a reduction in exports of CPC from China, and the same is true for coal tar pitch as well. You can see clearly that the reduction in exports from China has been offset by increased exports from the U.S. Besides stronger CPC demand overall, a good portion of these exports represent the execution of our India blend strategy, where product is shipped to India and blended for the domestic and export markets. On the lower left, we have watched closely the expected winter curtailments projected in China due to the initiatives that were taken for environmental protection by the regulators such as National Development and Reform Commission, NDRC, and Ministry of Environmental Protection, MEP. These were expected to impact smelting and calcination capacities within China fairly significantly over the winter months. From what has been reported to date, as indicated in the lower left bar chart, there is very minimal impact at just less than 1 million metric tons. We do expect, however, that China will continue these winter measures in the future, and environmental concerns are irreversible in the country at this point. On the CPC front, we are not sure of the impact on calcining capacity as yet, as there are no published numbers in this area. But the continued slowing of exports of CPC from China this year continues to drive demand in India and the region in general, and it would seem to indicate that the calciners in China were indeed forced to reduce production in accordance with environmental mandates. It is fairly clear aluminum production worldwide will need to expand to keep with demand growth. We are seeing the beginning of this with restarts of idle pot lines and previously shuttered smelting facilities in the U.S., as indicated on the left side of this slide. Most active is Alcoa, with a reopening of their Warwick smelter and restart of pot lines at Messina East. The bankrupted smelter of Noranda will restart as magnitude 7 during second quarter in New Madrid, Missouri, and Century is seriously contemplating restarting idle pot lines at their Mount Holly and Hawesville facilities in the second half of 2018. Clearly, this is the easiest and fastest production to help burgeoning demand, but the remainder will need to come from new projects in the future. On slide 8, the Q4 sales volumes in the carbon segment decreased by 9% year over year, predominantly due to a lighter shipment schedule in the quarter and some delays in CPC shipments into Q1 2018. To be absolutely clear, there is no slowing of demand for our CPC products, just the timing of shipments during the quarter. To this point, CPC sales volumes in India topped 800,000 tons for the year due to execution of our India blend strategy and aided by our SO2 scrubber investments over the last several years. Likewise, this supported a significant increase in capacity utilization at the U.S. calcination facilities. Our other carbon products volumes improved significantly due to the ramp-up of our distillation facilities and the contributions from our new projects, which increased production. Revenue from the carbon business in Q4 2017 is rupees 24.77 billion, which is 40.5% higher than the corresponding quarter of the prior year. This is a result of increased realizations across all product categories, coupled with improved volumes in our more specialized other carbon products category. The carbon business increased adjusted EBITDA by rupees 3.3 million year over year versus 2016. This was achieved through margin improvement and efficient blending of raw materials during the quarter. Also, the investments in our high-quality product lines and our aggressive cost-cutting initiatives over the last year helped control costs. Turning to slide 9, the chemical segment volumes, excluding trading, were moderately improved year over year with an improvement in revenues due to product pricing, which were ultimately offset by higher raw material prices. In total, chemicals had revenues of rupees 4.35 billion in the fourth quarter 2017, 9.1% higher than the corresponding quarter of the prior year, but operating profit was down rupees 0.7 billion year over year. The performance of the chemicals business was impacted by a few exceptional items which carried down the performance in Q4, including a small fire incident at our Uithoorn, Netherlands facility impacting production and a prolonged outage of anthracene and carbazole production in Germany. This concludes the performance update on the carbon and chemical segment. I now hand the call back to Jagan to address the cement business performance on slide 10.
Thanks, Sherry. During fourth quarter calendar year 2017, there is a mixed trend in sales volume in our cement business. There was an increase in volumes in certain markets such as Andhra Pradesh, Telangana, Tamil Nadu, Kerala, and Odisha, partially offset by decrease in volumes in Karnataka, Maharashtra, and Goa. Overall sales volumes increased by 7.8% and sales realization decreased by 19.7%. The revenue from cement business during the fourth quarter 2017 was rupees 2.12 billion, which is 13.4% lower compared to corresponding quarter of the prior year, and adjusted EBITDA was rupees 0.26 billion, which is 14.7% lower compared to the corresponding quarter of the prior year, mainly due to lower realizations and increase in the cost of inputs. We are working towards reducing costs by various efforts, the largest of which was the installation of the waste heat recovery power plant at Kurnool facility, which is enabling the plant to produce approximately 7 megawatts of electricity from the waste gases generated in the manufacturing process. All the electricity generated by this unit is consumed at the plant itself. Further, we have made cooler upgradation in our Nalgonda plant at a cost of rupees 156 million to achieve energy efficiency. A similar initiative is taken at our Nalgonda facility to set up another 4.1 megawatts of waste heat recovery power plant with a capex of rupees 500 million, which is estimated to commence its operations by January 2019. On a positive note, we have seen increased market demand in the states of Telangana and Andhra Pradesh compared to the previous quarter and anticipate this demand continuing throughout the year due to infrastructure and housing projects. Now I would ask Srinivas to update you on the financial position of the company. Srinivas.
Thank you, sir. A warm welcome to all the participants. Turning to slide 11, I would like to update you on the debt position of the company. At the end of fourth quarter of 2017, the gross debt is $1,158 million, including $50 million of working capital debt. Due to the appreciation of the euro against the US dollar, there is an increase in gross debt due to restatement of euro-denominated debt compared to the year end of 2016. Further, due to the additional working capital requirements driven by the increase in sales volume and quotations of raw material, the short-term working capital borrowing increased it to $50 million, an increase of $24 million compared to the prior year. Due to the partial refinancing executed in March of 2017, the average interest rate is favorable compared to prior year. The results of the refinancing were positive in that we extended the first maturity date from December 2018 until April 2025. The company ended the quarter with a net debt position of $999 million, which is slightly increased compared to net debt of as on December 2016, primarily related to the unfavorable euro versus USD conversion rate and incurring of debt refinancing costs. With $147 million of cash on the balance sheet and the unused credit limits of $100 million, the company is comfortably placed to meet its obligations and continue to make required investments to meet market demand. As stated by Mr. Jagan on slide 4, we have also completed our second phase of refinancing of the 2021 notes in January of 2018 with issuance of a euro-denominated term loan of 290 million euros at an interest rate of Euribor with a floor of 0% plus 300 basis points. Upon successful completion of the two-phase refinancing, the effective average rate of interest is reduced by 250 basis points. Turning to slide number 12, to the overall increase in volumes and quotations, the net working capital invested in the business has increased from $224 million as on December 31st, 2015 to $396 million as at December 31st, 2017, an increase of about $172 million. The company has minimal scheduled repayments for the next year, as the major debt repayments are not scheduled until 2025. The company has scheduled repayments of about $28 million in calendar year 2018 and about $61 million over the next 4 years. However, the company has the flexibility to accelerate debt repayment, either prepayment of term loan B or bond purchases after meeting the working capital requirements and the capex for the proposed expansion project. Thank you, and I will now turn the call over to the operator for the question-answer session. Over to you, operator.
Thank you very much. Ladies and gentlemen, we will now begin the question-and-answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thank you for taking my question. I had a question on the volumes on this quarter versus the last quarter. You mentioned some of this is from CPC shipments getting delayed to the next quarter. Could you help just, we're also seeing a decline in CTP shipments quarter on quarter. Could you help us with any kind of guideline on your sort of annualized rate of volumes in both CPC and CTP side for the next financial year?
Jenny?
No, we don't give guidance as far as the next financial year.
Right. On the restarts that you mentioned in the U.S. on slide 6, you mentioned 3 facilities where various amounts of smelting capacity will restart. Could you give us a sense on what that would mean for our volumes very broadly?
Well, in total volume, we're looking at between all of those potential restarts, we're looking at demand of about, I would say, 250,000 tons to potentially 300,000 tons of CPC. And again, that would not necessarily that would be more demand in the marketplace, which is already tight, but not necessarily just demand for us.
Got it. And just one last question on margins. We've seen your margin per ton expand quarter on quarter on the carbon product side. Just wanted to get a sense of, we've come to know about price discussions on price increases being taken towards the end of December and spilling out into January of this year. Are you being able to pass on the increases in your raw material costs? We know that there is a switch. The green coke prices are going up because refiners are switching towards more asphalt in their mix. Coal tar prices are on the uptick as well. Are you being able to pass these on and take advantage of the tightness are you able to potentially see that EBITDA per ton margin tick upwards, or are you just able to sort of pass on the increases in raw material prices that you're witnessing? Thank you.
Well, it's a good question. Thank you. We had a very sizable enjoyment of price run up last year due to the tightness in the market. We did have raw material prices increase as well along the line, quarter over quarter. But we're very pleased with our ability to outstrip during 2017 that the raw material prices because of the tight market. Now, fourth quarter, we had the benefit of being able to control our raw material prices. We will see them come up. We do not expect for the first quarter any large margin compression. But we are just trying to maintain our margins moving forward, which are at a healthy level for us from an industry perspective.
Thank you.
You're welcome.
Thank you. The next question is from the line of Kalpesh Koti from Veda Investments. Please go ahead.
Hello. Good evening, sir.
Good evening.
Yeah. So, two questions. One on the refinancing. So, what will the total interest saving for the calendar year 18?
See, basically, it should kind of work out to somewhere about $25 to $30 million, please. Yeah.
Okay. Okay. And so, second question on your tax rate. So, in the U.S., we see in the tax cut, I think in the Q4 we have shown some write back. So, can you explain something? How much amount we see the reduction?
Can you repeat the question again, if you don't mind?
On the tax rate, I think in this quarter we have some write back of the taxes because of the US and Belgium tax law changes. So, what will be full impact in calendar year 18 next year? So, what will the effective tax rate?
Okay. As you all might have seen, the U.S., the federal government has reduced the corporate tax rate from 35% to 21%. In Belgium also, there is a rate reduction from 34% to 29%. So, because of these two events, whatever the deferred tax liability that we have as of December 2017, the future tax liability has been stepped down or reinstated at the new enacted rate. So, because of that, we got a benefit of tax benefit, and the interest, the tax provision for the quarter is only about 37 million rupees.
We do expect the average consolidated effective tax rate for the group is around 36%. We expect at least a 2 to 3% reduction going forward from the calendar year 2018 onwards.
Okay. Thank you, sir.
Thank you. The next question is from the line of S.U. Reddy from Mergers India Info. Please go ahead.
Yes. Congratulations for a good set of numbers, and also for well-timed refinancing of debt and its flexibility you're able to achieve. My query is, one, your cement division performance is below par consistently when we compare with the peers in the southern region. Any reason for this? You're always saying some uptick, but I don't see in terms of bottom line there is any improvement. Can you throw some light on that, please?
See, mainly because very low cost of low capacity utilization. The cement plant has been operating constantly at a low capacity utilization. That is increasing the cost, and recently the raw material costs also have increased for coal and petcoke because of the duty increases, maybe because just an increase in the imported prices. So all these are adding up, and the demand has been slightly only going up, and the supply also has been coming in accordance. So hopefully, with the increasing in demand going forward, I think that should change. And the freight rates are also increasing because if you see in the last 1 year, the diesel cost has increased by almost 15 rupees or something like that, actually, if you see year-on-year basis. So all this is adding because we are principally a company that actually uses the trucks because our plant is not located somewhere near a railway siding. All these are adding up, but hopefully once there is some improvement in the cement demand, hopefully which should be, because we are seeing that uptick in both the states of Telangana and Andhra Pradesh. Though, we are seeing some downside in Karnataka and other places. So hopefully this should actually help us going forward and try to improve the performance.
Okay, thank you. My second query is, all our systems, IT systems are across the geographies well integrated to detect any early or prevent any kind of fraudulent or unauthorized transactions, especially in Russia?
Yes, actually we are in that process, and as a matter of fact, we are actually we are on SAP, and the entire global system is being integrated now. So we should complete that process, but yes, it's fully integrated. And we are actually on HANA, SAP HANA, the latest system. So I think, this should actually protect us from a lot of any IT distributions.
Okay, I appreciate that. All the best.
Thank you.
Thank you. The next question is from the line of Bhavesh Chauhan from IDBI Capital. Please go ahead.
Hello, sir.
Yeah. Hi.
So my question is on interest rate. Now, looking at the run rate of current, the quarterly run rate of 4Q17, I see that your interest on gross borrowings comes to something like 8.5%. So I was wondering why it was so higher. I was expecting a little lower, given that you had done refinancing in January.
Bhavesh, if you can look at the slide number 11, we provided the interest rate, what is prevailing as on January 2017, the old interest rate, and the interest rate that will be there as of January 2018, post-refinancing. Our average interest rate after the January refinancing is about 5.3%.
Okay. So second question is on spreads in carbon segment. Now, a lot of this, the mixture between better improvement in EBITDA per ton has come because of lower cost and cost optimization that you have done, and also product mix. So is it likely that this kind of spreads are, assuming the market conditions remain similar, we should improve our EBITDA per ton, given that your volumes were lower this quarter and actually they should go up?
Yeah, you might have seen some increase in the volumes, both in CPC as well as coal tar pitch, and also other carbon products. There is an increase in volumes year on year there is a 6% increase in CPC there is a 8% increase in coal tar pitch and about 16% increase in other carbon products. So the increase in volumes are also contributing because some of the fixed costs will be spread over a larger volume, and because of that, we expect a similar performance could be there.
Okay, sir. Thank you.
Thank you. The next question is from the line of Sanjay Kumar from Vision Investments. Please go ahead.
Good evening.
Good evening.
Congratulations for a good set of results.
Thank you.
Just wanted to know, the debt seems to be increasing gradually, even though at a slower pace. So will there be any concrete indications for an ADR issue whereby you can raise up to about 1,500 or 2,000 crores and reduce the debt, which can totally transform the company?
Actually, you will see reduction of debt actually starting this quarter, because we did, as part of our debt refinancing, we did actually repay a portion of a debt on January 16th. And hopefully, with better cash accumulations, and it also, our current debt permits us to reduce our TLB, what was raised in euro, actually we have the option to prepay the debt. So with these things, I think, you will actually, there is an opportunity for us to reduce our debt going forward.
That means you will be buying back the bonds which have been...
No, we can actually repay our term loan B, which was raised on January 16th. Actually, we have an option to prepay at any point of time.
Okay, so there is no plans for ADR or anything like that? Because last 3 years we have been waiting.
No, because at this point of time, I think, we have a healthy cash flow, and hopefully, we should be doing well, and our leverage ratio should be well under control. We should be able to bring it down well. So with all these things, I think we should be able to repay the debt.
Okay, thanks.
One small clarification to you is there is an increase in the debt because of the appreciation of euro against US dollar. Yeah. And there is a minor increase of about $26 million in working capital, $24 million, because there is almost $100 million plus increases there in the working capital. And so actually, the two factors have contributed to increase. Otherwise, there is no increase in the debt actually.
Yeah, but one in terms of rupee, in case the rupee weakens now from 65 to 67 over a course of 1 year, again your debt will start to look slightly worse in terms of rupee value.
I do agree that, but the only thing is 90% or 85% of our operations are outside India, where the cash generation also will happen in dollars and euros.
Okay. Yeah. And just second question is, this rates in Europe are moving higher. So in the previous year, you had a very stiff pension liability exceptional. So going ahead, as I think you had fixed it at 1.22. So currently, in Europe, the rates have moved to around 1.55 for the UK 10 years. So going ahead, if there is a rise gradually, just like the US 10 years, will we have benefits on the pension liability front?
Yeah, as and when the European interest rates will come, the pension liabilities could decline because of the actual assumptions will undergo a change. Yeah? But any change in the interest rates and the actual assumptions will not be taken to the profit and loss account. They are adjusted directly in other comprehensive income.
And so what is the base rate as on 31st December for investors to gauge the pension liability, this one? What is and to which rate of this one is the pension liability linked?
It's a 10-year German bond. The German government bond is the benchmark for calculating interest rate.
Okay, yeah. That is very important, yeah. Because that has moved up from negative 0.78 to currently in positive to 0.68. So if there is a movement higher, won't we have good income from the liability front? That's what.
It will impact to reduction in the pension liability, but as I indicated to you, it will not be recognized as a profit or loss in the quarter, it will be adjusted in the balance sheet as a other comprehensive income.
Okay, and one more small last final question. In your disclosures to the exchanges, you had actually mentioned in a small footnote that your prepayment cost would be 10 million. That is about around 65 crores. But in the results, it has come at 111 crores. So why that so much of a difference for the prepayment?
The prepayment premium is basically the $10 million, that is 65 crores. But we also had, because of the reimbursement of 2012, redemption of the 2012 bonds, there was a unobserved deferred finance cost that was actually there of about $8 million. So that also, though it is not a cash expenditure, we actually had to write off the deferred tax finance cost. So that was the reason why.
Yeah, just to clarify you, the bonds that we redeemed are due in January 2021, and we have originally issued these bonds in December 2010. And all the debt issuance costs will be capitalized and amortized over the life of the bond. If there are 8 years, life of the bond is 8 years, we have written off the liability till December 2017. Now the bond is already repaid on January 16, 2018. It will be prudent to write off all the unamortized deferred finance costs or the debt issuance costs. That's why there is a difference in the disclosures made. In the December press release, we only indicated about the redemption premium, but in the annual audited accounts, it is redemption premium plus the debt issuance cost. Both were there.
Yeah, because of that, I think slightly markets have slightly been disappointed by this one. Anyway, thank you so much, and we hope the debt will decrease. That is what is our investors, most of the investors. Thank you so much.
Thank you. The next question is from the line of Jimesh Sanghvi from Principal Mutual Fund. Please go ahead.
Hi, sir. Congratulations on good set of numbers. Wanted to have your thoughts on the percentage increase in the raw material cost in the carbon segment from the fourth quarter to, say, the current trend which is there, and what percentage of raw material cost increase has already got reflected in the fourth quarter numbers?
Jerry?
Yeah, from the fourth quarter perspective, we were able to, in most part, maintain our raw material costs from the third quarter. And in the first quarter, we're seeing an increase. I do not have exact numbers on what that increase is, but we're comfortable in being able to cover the increase with an increase in our sales prices as well.
Okay, so to be on the safer side, can we assume that the current margin trends which have been reported is something which can be easily safeguarded by the company in the first quarter as well as going forward?
Yeah, I would say, the fourth quarter margin is something that we're managing toward protecting. We may see a slight incursion, but again, the margin that we had in the fourth quarter, in general terms, should be something that we can we should be able to protect.
Okay, fine. Thank you, sir.
Thank you. The next question is from the line of Sured Deora from Mentor Capital. Please go ahead.
Hi, this is also a question for Jerry. Just wanted to get any more insight that you could throw on the Chinese market with regard to CPC supply post Chinese New Year, and also with regard to CPC supply versus the closure of aluminium smelters. I guess the concern is could there be a situation where the aluminium demand in China is lower and the CPC supply is higher, which puts pressure on prices globally?
Yeah, thanks for the question. I think simply put, China leaves itself, available because of a lack of continuity of information, open for constant consternation. But to share with you what we are viewing and what seems apparent to us is that China has gone through this winter of mandated curtailments, but truly as expected, if you reflect on our commentary, it was likely to be minimal. The actual curtailments in China, which was a larger impact, was smelters that were forced to close earlier in the year from a perspective of they had promised to close because they had replaced with new capacity, or they were what was deemed illegal capacity. They were not properly permitted, and the government shut them down. Far outweighs the curtailments that we ultimately have seen, as you see in our slides, due to the winter curtailments mandate. With that said, the intelligence that we're getting out of our Shanghai office is that the curtailments of calcining are, from what they're seeing, are more substantial than even the curtailments on the smelters in aluminum capacity. Remember, there's a lot of ways that the smelters could have stacked up anodes. But I think to put it in more simple terms for you, there is nothing in the marketplace, either in China or outside of China right now, that we see changing from what we experienced in the second half of 2017. And that's what gives us confidence in saying that we feel that we will be able to protect our margin moving forward. Will it be exactly the same as it was in the fourth quarter? I can't say that. But in general terms, we're not worried about large-scale margin erosion at this point, and the market seems still tight of CPC product, and demand remains strong from the aluminum sector globally as well as in China.
Okay, and is it also fair to estimate that, because you mentioned that there was some delay in shipments in quarter 4 and those have been moved to quarter 1, are those delays because of inventory issues or because of price negotiation issues?
No, they were really a couple. The largest impact from us related to us was actually a customer's ability to receive product, and in the quarter, due to some force majeure type conditions that were affecting them. So we agreed to push those volumes into the first quarter. And then we had, beyond that, the very usual run-of-the-mill, just timing of shipments in December that timing-wise, fell over because some of these are ocean-going vessels that can be a few days late or come in a late can window of a week that pushed up against the end of the year.
Got it. And so I just want to touch once again on China point. Is Chinese New Year usually an important milestone or calendar event for you to track to see how things change? Like, could there be a substantial change in the coming quarters because of the curtailments at least reducing and some of these capacities coming online?
No, it's a good question because we know from a lot of commodities that the Chinese New Year can affect change. We especially see that in demand like coal and other commodities that are imported into China, that the New Year can really be a stake in the ground and a statement about their buying patterns on the New Year. First and foremost, remember, we do not supply product into China. Right. So we're not affected by any fluctuation. It would have a ripple effect on the market. But there's nothing that we're seeing from a China perspective that's saying that the Chinese New Year had any effectual change on the market dynamic in China or outside from a demand perspective. And the one thing I'd add from the Chinese perspective is that China, based on new smelting capacity that's under construction, is scheduled to bring online anywhere from kind of 3.5 to 5 million tons of additional aluminum production capabilities. If you look at the way China is right now, there's not availability of carbon to fill that carbon demand for that new aluminum production. So, 2018 presents its challenges before you even consider, in order to stay in balance, China would have to reduce from other facilities that amount of aluminum production to not even put further stress on the fairly delicate supply situation of CPC and coal tar pitch.
Okay, great. Thank you very much.
Thank you.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Hi, sir. Good evening.
Good evening.
Sir, you mentioned that definitely we have seen an increasing trend in prices, both in input as well as output prices as well, and that would have helped you during this chain, some inventory-led margin and some inventory-led higher profit. So when the prices of your end product as well as raw material stabilize, that where you see that what will the fair margin for the company will be, and I think that those will be more on a per kg or per ton basis rather than looking at the percentage margin, isn't it?
I'm sorry. If you're asking for a projection of the unit margin of our products, we don't provide guidance of.
No, not looking for the guidance, but what is the more stable margin? I mean, for your product portfolio, you will be looking, because we have seen an increasing trend in both raw material as well as in end product prices. So.
Yeah, our target, as I've expressed, our target for first quarter is to maintain our margins that you've seen in the second half of 2017, and I believe we are well positioned in order to do that.
Okay. So second is, if you can just give some duty structure in across our product portfolio, and there is some chance of the changes in export duty scenario from the government. So how it is going to affect us?
Yeah, the duties that have been discussed in the government are contemplated right now to land as an increase from 2.5% import duty to 10% on a product, and from our side, we would pass that duty, and we've already had discussions with customers in India that duty would be passed along to them.
So the import duty is likely to be increased from 2.5 to 10%.
From 2.5 right now, the latest indication we have of the mandate is that it would be an increase of 7.5%, from 2.5% to 10%.
And it will be on what products? I mean, only CPC or across the carbon products?
I think it's only on CPC. We don't do any import of CPP into India.
Both on CPC and GPC, please.
It will be both on CPC and GPC.
Yeah, both the raw material and the finished product.
Anything that's imported into India, either GPC or CPC, will receive that level of duty.
Okay, and if approved by the government, from when it is likely to be applicable?
So it's already approved. It's effective January 15th. It's already approved.
But it's already applicable from Jan?
It's already applicable to all the imports into India.
Okay. So you have...
Rohan, may we request you to come back in queue for follow-up questions? Thank you. We will take the next question from the line of Vihang Subramaniam from Deutsche Bank. Please go ahead.
Yeah, good morning. Good evening, Amin, and congratulations on a strong set of numbers. I just have a couple of questions. So the carbon revenue improved only like 3%, whereas prices rose like 30%.
Sir, you're not audible.
So the carbon revenue rose only like 3%, whereas prices rose like 30%. So is that because of lower volumes?
I'm sorry, can you repeat your question?
Sure. So the carbon revenue improved only 3%, whereas the prices rose 30%. Is that because of the shipment delay?
The revenues increased more modestly than the profitability?
No, than the prices. Hello?
Yes. Yes. So the impact, yes. The impact would be you have to look at the mix of we had lower volumes, which will contribute to lower overall revenues, but we had higher prices that helped offset the revenues. The higher prices added to the revenue, if you will.
Okay. Makes sense. Just another quick follow-up question. So the Section 232, which is going to be implemented in U.S., aims to improve U.S. aluminum industry utilization rates to 80% from like current levels of 46%. So does that imply like greater demand for carbon products? And I know this is a little far-fetched. It could be an 18-month horizon kind of a thing. But do you have the capacity to tap that increased demand, or you need additional capacity for that?
Well, I can't comment on and as you say that those projections are, you take them at the value they're given. But anything, I think the easiest way to address that is any increase in demand or any increase in aluminum in the United States will result in an increase in carbon demand for our products, both coal tar pitch and CPC. And so we will be very well placed, to supply that demand, and it would be preferable to us conceivably because it's closer with less distribution cost overall. So if it's yielding better prices than we can get with our India blend strategy, we would prioritize that the volumes here in the U.S.
Okay. And just a last question. So the volume, so the shipment delay to 1Q18 that has happened, like, is that expected to normalize?
Yeah, most of our shipments have been delayed. Actually, have already gone in the first quarter, in the first January. So generally, these things happen. Basically, it could happen at again next quarter. It could not happen. So this is normal part of shipments because it could, the shipment doesn't leave on December 31 at 12 o'clock. Then if it goes on January 1st at 2 o'clock, basically it means that the bill of lading is next day. So it basically is counted towards next quarter.
Okay.
Jagan, thank you for that. It's worth noting that if you folks look at historically, we will have volume fluctuation from time to time, just based on product timing. So it's not indicative, and that's why I unequivocally made the statement. To be clear, there's no concern about a reduction in demand for our product based on just that quarter over quarter prior year reduction.
Okay, thanks for the clarification.
Thank you. The next question is from the line of Jigar Savla from Vitter Funds. Please go ahead.
Yeah, on the same thing of the volume. So basically, the 14% reduction in volume on a year-on-year basis is something which you say will be compensated in the first quarter of this year.
Yes, please. It is just a timing difference. Basically, this is a routine thing in the business because our each shipment is 25,000 tons.
Right.
So a couple of shipments missing is actually, which means this can be made up.
Right.
So this is just a routine part of the business.
Right.
So yeah.
So what has been the increase in realization on a quarter-on-quarter basis from September to December quarter on blended basis?
As you can see, we have given the volumes and the revenues, so I think you should be able to see that and calculate that, please. We don't give it by project, by product, but generally we did in our press release, we did give you both the volumes as well as the revenues, so and by product, by division segment-wise, so you should be able to calculate that.
Right. And the realizations would be stable or upwards even in this current year from the December?
So we do not give forward guidance, but
no, the Jan Feb, not the forward.
As Jerry said, we will always work towards keeping our margins or maintaining our margins.
Right. I'm not asking about the margins. I'm just asking of the realizations in January, February are at the same level or higher than the December.
As you said, we cannot comment on this current quarter, but we always work towards maintaining margins. Please.
Okay. Thank you very much.
Thank you. Due to time constraints, we will take the last question, which will be from the line of Gunjan Kapra, individual investor. Please go ahead.
So my first question is regarding the cost. Like the GPC, the prices have risen in Q1 also. So I understand that we do SO2 scrubbing too. So the high sulfur and we blend high sulfur and the low sulfur coke, right? So what is the saving that we do by using the SO2 scrubbing strategy? What are the raw material? What are the cost savings that we do?
Jerry?
Yeah, we don't publish exactly what it is, but by rule of thumb, you can look at the differential in raw material costs at a given point in time based on high sulfur versus the lower sulfurs we would need to run if we didn't have the SO2 scrubbing. You can look at the price difference being anywhere from $20 to $60 per ton.
Okay. And sir, regarding this freight cost, there is
echo from your line. If you can just turn off the speaker if it's on.
Yeah. There's a freight cost increase in the US by 15 to 20%, I guess. So how are we planning to mitigate that?
Our strategy to move product to India, we do use a hedge strategy on freight. That if we do research to understand where we believe the freight markets are going. So we have positioned ourselves to not be as vulnerable to the freight increases that we've seen over the last several years. But something to consider beyond that helps to keep us very competitive and is a very intelligent way, I would say, to look at your business and pragmatically deal with it. But any freight increases that you see in the marketplace, as you mentioned, 20%, that 20% is on all freights. And we move in large shipment sizes, so 50,000 plus. Our CPC movements from the U.S. into India, while it's a long haul, we take absolute advantage of the larger size vessels. So the freight increase that you see would also be a 20% freight increase for product coming out of China or anywhere else. So we feel comfortable with the fact that our shipment size essentially keeps us competitive from a freight perspective when the freight moves up or down, and that's part of our total India blend strategy.
Thank you very much. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Mr. Jagan Mohan Reddy for closing comments.
Thank you. The consecutive positive performance of the company is quite encouraging. The performance, which is primarily driven by operational excellence, will allow the company to sustain its earnings going forward in a normal and stabilized market scenario. The company will continue adding sustainable, lasting value in line with its strategic plans and integrated global business model. Continued monitoring of market developments and adjusting accordingly to maintain its operating strategies will continue to benefit the company, in addition to making strategic capital investments from the available opportunities, both internal and external, that meet our investment guidelines. Although certain products in the chemical businesses are facing headwinds due to competition and technological changes, the company is currently focusing on improving the performance of the chemicals business and is developing a new chemical portfolio for maximizing the value addition from byproducts produced during tar distillation. I would update you on the initiatives taken by the company to improve chemicals performance in the next 1 to 2 quarters. Further to the greenfield expansion, such as our Indian shaft calciner project, the company will continue its initiatives to improve capacity utilization across all its production facilities. Thanks for participating in today's call, and we look forward to speaking with you next quarter. Thank you.